What's going on, everybody? Welcome to the Frankie D'Astoli Show. I am your host, Frankie D'Astoli. I am hyped. I got my boy, CJ Tarantino, the real estate CPA in the house. I'm very, very excited. CJ is the founder of Tarantino CPA and a seasoned CPA with over a decade of experience at top firms. Specializing in the real estate investment strategy space, he helps high-income earners build and preserve wealth through advanced tax savings tactics like cost segregation and 1031 exchanges, things we're going to be talking about today. With a deep passion for real estate, CJ is dedicated to simplifying complex tax laws and equipping investors with the strategies they need to achieve financial success. CJ, my man, how are you?
Good, brother. Thanks so much for having me. Happy to be here.
Absolutely, bro. I'm excited to have you on. I think as I was kind of mentioning before we got into this, I think for real estate investors, we focus so much on the building, right? And in general, the actual asset, the building, of course, but building a portfolio, building passive income, where I think really the two biggest things that we forget about until we absolutely need them is asset protection and tax planning, right? When we have a lawsuit and we're like, oh, snap, are we protected? Or when we go to file our taxes and all of a sudden we're like, why do we owe, $50,000 or whatever the case might be? And that's why I love interviewing people like my boy Justin Eaton, who's in laundromats. I love interviewing other people that are in real estate, but having someone on you on the pod, CJ, this is, I think, where I really provide a lot of value to listeners. So I'm very excited. Thank you so much for jumping on. And I'm really excited. Tell us a little bit, I know I gave a little bio there, but tell us a little bit about your background, who you are, what you do.
Yeah, so I'm a CPA. I've been in the industry for over 10 years, came up through big CPA firms and kind of rounded out my knowledge base and got exposure to some really cool strategies and clients there. And a little over a year ago, started my own practice and just have the passion for helping real estate investors optimize their tax strategies. I think there's a lot of people out there who focus on the compliance aspects, which we can help with as well. But really what we want to help with is the strategy and proactive strategy and making sure you're getting out in front of these issues. Kind of like you touched on, sometimes you don't deal with it until it's becomes a problem. We want to help you get out in front of it and be proactive about it.
100%. And I'll speak from personal. I mean, CJ's doing my books right now. We had such bad bookkeeping last year. And thankfully, I'm very thankful for CJ because he's going in there and cleaning it up. And it's going to give us a great view into what's going on last year. But again, that's exactly what I'm talking about. Like, what do we think about on a day-to-day basis as real estate investors? We think about buying the next deal. How are we going to fund it? How are we going to get a tenant in there? How are we going to refinance it? How are we going to sell it? What type of finishes are we going to do? All these things that go through our mind day in and day out. And that's why it really is so important to have a CPA on your team. And, a lot of times I relate to Robert Kiyosaki, and he talks about this stuff all the time, right? He talks about having your advisors. And CJ, exactly what you pointed out is really making sure that we have kind of those tax planning strategies ahead of time. And let's just get into that a little bit. As a real estate investor, what are some tax strategies, that I could plan for ahead of time, that investors could plan for ahead of time?
Yeah, so kind of jumping into the basics, right? So one is just making sure you're tracking your time in real estate because maybe something like real estate professional status pertains to you. That is where if you spend at least 750 hours during the year and more time in real estate than any other activity that you're doing. So if you have a W-2 job, you'll find that you'll kind of have trouble meeting this criteria, but we'll talk about some other options for those. That's where you really can tap into the full benefits of real estate. And when I say full benefits is, a lot of times with real estate, you're generating paper losses like through depreciation, right? Definitely. And those losses are generally passive losses. So real estate professional essentially makes those passive losses active for you. So opens up the ability to take them against other sources of income. Right. So real estate professional status is a big one. So I'll kind of stop there and see if you have any follow-up.
Yeah, I think, in regards to that, if you're a real estate professional, which I know you mentioned 750 hours, all right, so I'll use myself as an example, right? I left my W-2 back in, June 1st of 2024. So I would only be that 6 months. So I don't know if this past year necessarily, maybe I would qualify, maybe I wouldn't. But let's just say for the year of 2025, obviously I'm in this full time. What are things that I would necessarily need to provide you to show that I'm in real estate full time, real estate professional, 750 hours?
So really you want to keep a log. We have a template that we provide to clients, but it could be something as simple as like a quick Excel, just documenting, okay, the date, the time spent, the activity that you performed.
Yep.
There's also some apps out there that can make it a little bit more streamlined, but a lot of people just opt for a quick Excel they can access and fill out there. And really, It's just if you were ever audited, we hope that's never the case, but if you were, they're just going to want to be able to substantiate the position of here's how I'm showing you that I spent the time in real estate.
Yes.
So,
and go ahead. I'm sorry.
Yeah. It's just really documentation is key for most things.
Yes. I feel like every time I talk to you about this stuff, that's like usually the answer for a lot of things, right? When it comes to that stuff. So if let's just talk about, whether you hit that real estate professional or you don't hit that real estate professional, if you're a real estate investor, there's things that you're going to kind of come into, especially kind of one that you touched on that I want to talk about, which is depreciation. What exactly is depreciation and what does that do for a real estate investor in regards to those paper losses?
Yeah. So depreciation is really a tax concept where you buy a property, but we're talking about real estate specifically here. So you buy property, and often with real estate we know it appreciates in value, right? Especially if you buy the right deal. But depreciation is essentially recovering the cost over time for tax purposes. So you buy a piece of property. A portion of your purchase price is going to be allocated to land.
Yep.
And that's not depreciated. And then a portion is allocated to building. And that is the piece that you get to depreciate.
Yes.
So depending on what type of property, residential, it'll be 27 and a half years. You get to basically recover your purchase price over 27 and a half years. And that's essentially a loss that's created year to year that you can use to offset your rental income in combination with your other kind of operating expenses.
Got it. And for the split between land and building, is it a real estate investor's responsibility to determine that, or is that something that a CPA would typically do?
So we can assist with that as well. Usually what it's based off of is just kind of the property assessed value. So a lot of times the property taxes, they'll assess a value to land versus the structural component, the building. So we can use that. If an appraisal is done, that could be used as well. But a lot of times in a practical sense, we'll pull from like the property records of the county and kind of rely on that and have that in our file as to why we took that ratio.
Got it. That makes a lot of sense. And I think on depreciation, and again, I'm not an expert on this stuff, so I might say some stuff that's really stupid, but like, can you also depreciate capital improvements? Are those considered depreciable? How does that work? And what's really the difference between like capital improvements versus like expenses? How would you really document that stuff?
Yeah. So that's, where we're able to add a lot of value there is because that's a very common question is, right? I have all of these expenses for my property. How do I navigate what's a repairs expense versus what needs to be capitalized and depreciated?
Right.
So there's what's called a de minimis safe harbor election, which we include with almost all of our real estate clients. And that's if any individual expense is under $2,500, you can go ahead and expense that. Now, when it gets above 2,500, a little bit more analysis needs to go into it as to what specific improvement or expense was incurred and kind of understand the facts and circumstances. But in a lot of cases, those items would be capitalized and depreciated. And for tax purposes, without getting too much in the weeds, every type of item has an associated life for depreciation purposes that the IRS kind of assigns. So, like land improvements is 15 years, personal property is 5 years. So that's that you kind of have to look at what the specific item is.
Got it. And in regards to like and I like to play in the weeds a little bit with some of this stuff. You buy a property, right? As a real estate investor, you buy a property. Let's just say you buy it for $100,000. You get a $50,000 renovation budget. You spend that $50,000 totally revitalizing the house. Are you able to take that $50,000 and consider it a full capital improvement, or do you need to pretty much like say, well, I spent $40,000 on HVAC, roof, a full kitchen remodel, 2 full bathroom remodels, and then the other 10,000 went to paint and like some exterior like work, stuff like that. How would you really kind of break that stuff down?
So I would say the more detailed you can be with it, the better, because you want to be able to identify, okay, this is a shorter life, so we'll get more depreciation up front and we'll have to wait less time to get it. So the more detailed you can be, the better, because you don't want all of it to be assigned to the, longer 27 and a half year, span for depreciation. And I think what would be really good value here in terms of depreciation and kind of what we're talking about here is just kind of jumping into cost segregation, because I think this plays into really well with what we're talking about.
Yeah.
So, like I said, the recovery period for property is 27 and a half years. Unless it's commercial, then it's 39 years. So even longer. Cost segregation is a way to accelerate that. So it's a way that, an engineering firm would go in and they'd identify what could be categorized for depreciation. So they essentially break down the property and break out components that can be depreciated quicker. Okay. And the highlight here and why that's important is because those shorter asset classes are eligible for bonus depreciation, where building 27 and a half year is not eligible for bonus. So it opens up that door.
And I want to, sometimes I need things explained to me like I'm in, 4th grade. Like if I depreciate a house, okay, and it's broken up over 27 and a half years. So just for simple math, the house is worth $100,000. If it's divided, it would be necessarily divided by 27 and a half. And that's how much I'd be able to depreciate it per year. Is that correct?
Yes. So with that, it's straight line, pretty straightforward. With some of the other ones, is a little bit more of a calculation that goes into it. There's IRS tables of like how much you get. So it's not like a straight up like over 5-year period. Like it's a little bit more in the first year, a little less going forward. So, but yeah, for the building, it's generally a straight line approach.
And for cost segregation, there's certain categories where that particular part of the house might be, over, and I'm using random numbers here, might be over a 15-year, but through cost segregation, you could load a lot of that up in the first few years, is what you're saying.
Yeah. So what's going to happen when you get a cost segregation study done? They're going to take a property and let's say 500,000 was originally supposed to be depreciated over 27 and a half years.
Yes.
They're going to take that property and they're going to reassign that 500,000 to a portion will remain 27 and a half, but then they're going to reclass it into different buckets, 15-year property and 5-year property. It's generally about 20 to 30% will be reallocated on average, just a kind of rule of thumb.
Yep.
And that 15-year and 5-year property would now be eligible for bonus depreciation. And that's where a lot of your value is coming from, because you're able to now front load that depreciation where you would have had to wait over the 27 and a half years.
Yeah. Now, why would some people want to do that?
So the reason you'd want to do that is in a year where you need those losses to offset another source of income, or if you're a real estate professional like we talked about, and you'll benefit from those losses. So a lot of these strategies work together, and it's really important to work with someone who understands your situation. So, it's not as simple as just like everyone should do a cost seg. It's really understanding like your situation, if you're going to benefit from them.
Right. Yeah. Because if you're looking at it from a perspective of, you have an investor who has a lot of rentals and they are using depreciation to already offset any income that they've made for the year, would it makes sense for them to still cost segregate in that case? And from what I'm understanding, it would only really make sense if they maybe make income somewhere else and they could use that cost segregation to, kind of hammer down and chip away at that income positive on the other statement. Is that correct?
Yeah. So I'll give you an example. So
Sure.
I have a client that sold one of their properties,
Yes.
have a large gain. Now they're doing a cost seg on another property to help offset that gain.
Okay.
Now, in a case where you do a cost segregation study and you create those losses, it wouldn't necessarily that you'd lose them if you couldn't benefit from them in the year.
Got
But
it.
you could carry them forward and utilize it in a year where you would need it. But to incur the cost of doing the study, you want to make sure that it's going to benefit you in the way that you understand and you're intending to have it.
Yes.
So a lot of people will run out and get in the study and then, take it to their CPA and find out that, hey, I didn't benefit like I thought I would.
Right. How do you go about ordering a study for a cost segregation?
So we have a few referrals that we give to clients and kind of let you choose, what's the best fit for you in terms of personality, process, price. So we have a couple options of people that we refer out to, but there's many providers out there, and I would just warn people to just be careful with like the do-it-yourself study. I would get the one where some analysis is going into it from a professional, although that will come at a little bit higher of a price point. You just want something that you can substantiate if you ever got audited, because a lot of times these studies are generating large losses for you. So you want to make sure you have, foolproof kind of support for your position.
Yes. No, that's great stuff. Cost segregation, I feel like it's very interesting. I feel like I've been reading like a little bit more about it, and I'm like, this sounds lethal, but also sounds like kind of complex. And honestly, the example you gave was actually huge for me, and I think really big for anybody that's listening is a situation like that, right? You have someone that sold this property, they made a lot of money from it. They need to really, put a little steroid in their depreciation so that they could offset that. So that's awesome.
Yeah, and I'll just give you one other kind of golden strategy here, right? So with a lot of times we'll have someone that's a high income earner, and then if they're married and their spouse can focus on real estate and kind of meet that reps criteria that we were talking about, you could go and do a cost seg on your property, kind of create those losses, and then use that against the other spouse's income. So that's another way that we can layer in cost segregation. So there's just a lot of great tools available for real estate investors.
That's so sick. I want to highlight that one more time because I know people that are in this position. If you are working a full-time job, where it could be vice versa, but if you're working the full-time job and your spouse is not working the full-time job and she's able to show that she could provide that she's a real estate professional, full-time real estate professional, which means she's dedicated 750 hours working on your portfolio, working on your properties, you can cost segregate properties, and correct me if I'm wrong on any of this, CJ, you could cost segregate properties through that portfolio that will offset the income that you as the spouse who's working your regular W-2 job are making.
Yep, exactly. So I'll give you an example. We work with a lot of like high income medical professionals or people in the tech space, right? And so they're high income W-2. Their spouse is spending the time in real estate. So 750 hours at least, and then more time in real estate than anything else. And as long as you meet those criteria, then you can kind of combine the two and get a really powerful result. Great strategy.
That's sick. Now, if you're not a real estate professional, full-time real estate professional, can you still benefit from depreciation, cost segregation, things like that?
You can, but your activity will be deemed passive, and therefore it will only be able to be utilized against other passive activities.
Gotcha.
So, if you have another property that's generating income, and you do a cost seg on another property, it can combine and offset that way. But, a lot of people think that, as a passive investor, you're not really benefiting, but you are in the sense of you're generating rental income that's being offset by depreciation. So that's in itself tax advantaged, way more than like as a W-2 earner and you're just being taxed on whatever you make.
Yeah.
With real estate, you're able to generate rental income and still take depreciation against the rental income.
Got it.
It's just when you're trying to get to that next level of how can I take these losses and offset it against active income is where as a passive investor, you run into limitations.
That's so tough, man. That's so tough. See, these are really like these, I don't know if you necessarily would call them loopholes. They're more so strategies, but like they're just these things that you just don't know. Like you really, really don't know. Nobody's teaching any of this stuff until you listen to a podcast like this, and all of a sudden you're like, oh my gosh, my mind's blown. I want to talk a little bit about I had a friend of mine, Bonnie Gallum, on the show a little while ago. We were talking about asset protection, and obviously like the gold standard for asset protection is a limited liability company, an LLC. Why is it, and I don't know the answer to this, why is it that I have an LLC, but I want to be taxed as an S-Corp? What is an S-Corp really in regards to that, and what's the advantageous benefit there?
Yeah, so the S-Corp, and you want to be really careful with this. So from a tax perspective, with the S-Corp, you don't want that structure for buy and hold real estate.
Okay.
So for properties that you own and you buy and hold, generally, a S-Corp is not an ideal structure.
Yes.
There's a number of reasons why that's the case. But for S-Corp, to answer your question, is more for like active real estate activities. So for flips, for wholesaling, for coaching, things like that would be a great strategy for as an S-Corp. And really what the play there is you're saving on some of the self-employment tax. So with the S-Corp, you're required to pay yourself a reasonable salary from the S-Corp.
Okay.
And so it does create some administrative burden now of, hey, I need to run payroll at least one time in the year to pay myself a salary. The S-Corp has another tax return now that you wouldn't have had if it was just like a single member LLC.
Yes.
So that's why we generally recommend at about net profit of 50K is when the S-Corp strategy will start to benefit you in excess of the cost that it will take to kind of worry about payroll, file another return, and kind of deal with those things. At 50K, it starts to be worth it.
Of active income.
So that's like wholesaling, flips, coaching, where you're not buying and holding real estate.
Yeah. Again, one of those things, you would never know these types of things. You really wouldn't. We talked a little bit about, you kind of touched on for a second, a little bit about payroll. As a real estate investor, and you could break it down for like single member partnership, what's the best way to like really pay yourself? Whether you're a buy and hold investor or a flipper, it seems like you would maybe go with the S-Corp formation, but let's just say for the, argument's sake, the buy and hold investor, what's the best way to really pay yourself through that?
Yeah. So just kind of the different structures require kind of a different process.
Yeah.
So for like the S-Corp we touched on, you need to pay yourself a reasonable salary.
Yep.
Then you can take the excess profits as distributions. And that's the piece where you're really saving. Those distributions are avoiding the self-employment tax because you're paying the payroll tax on your salary.
Makes sense.
So now when we get to a like single member LLC, that's where you're going to be taxed on the profits that the LLC earns. So it's as simple as just distributing from the business bank account of the LLC to your personal. So you basically take what's called an owner's draw of taking a distribution from the LLC. It gets a little bit more complicated if it's multi-member. So multi-member partnership, that's more so where you're relying on the structure and how the operating agreement is set up. So, in the terms of the agreement, you would kind of outline how distributions work and you would follow in accordance with that.
Yeah. That actually makes a lot of sense.
From the business account, you would take each member would get their distribution from the business account of the multi-member LLC.
Got it. Yeah, that makes a lot of sense. Sometimes as an investor, you just think, the operating agreement, I just send that to lenders when I need to buy things. That actually has a very big tax purpose to it as well. So that's important to know. That's awesome. I know I wanted to touch in a little bit about, BRRRR versus flipping in regards to tax saving, because I know with flipping, one of the big tax strategies that we talk a lot about is 1031 exchanges. If you want to touch a little bit about that, and then we'll kind of pivot it into cash out refinances on the back end for if you were to do like a BRRRR type strategy. So if you want to touch on 1031, let everybody know what that is and kind of how you could utilize that.
Yeah, so a 1031 exchange is really a great tool for real estate investors. And what that essentially is when you sell a property that you hold, you, instead of paying the capital gains tax that you would pay on the sale, you essentially roll the profits into another property of like kind. So you sell a property, you would typically have a gain that you'd have to pay tax on. Instead of paying the tax on the gain, you defer the gain and roll that into another property. So essentially allows you to scale up.
Right.
It allows you to create a portfolio tax-free. The tax is deferred. It's kind of built into your portfolio. So if you ever sold it down the road, you would have to worry about the tax implications then. But there's a common kind of terminology that real estate investors use, who have been doing this a long time, is kind of swap until you drop. So you just continue to do 1031s until you pass, and then you're able to do some things with leaving the asset to your heirs and kind of avoid that tax issue then.
Yo, I absolutely love that. That's my first word. Swap until you drop. That's fantastic. I'm about to start flipping houses just so I could caption that on Instagram. All right. So
I just want to highlight on there, though, on the 1031. So, a lot of times with the tax strategies, people can make them seem a lot more easy than they are, right? So there are some things you rules and requirements you want to make sure you know and follow. So with 1031 exchanges, really great strategy that a lot of, top real estate investors use, but there are strict requirements with it. So, when you sell the property, you have 45 days to identify a replacement, and then you have 180 days to close on one of the properties that you identified. So the timing is tight. So you don't want to necessarily force yourself into a bad deal just based on the timing. So you just want to make sure that as always, the acquisition should be part of your investment strategy and tax benefits second. You don't ever want to just chase tax benefits and force yourself into a bad deal.
Yes. Yeah. Now, 45 days to identify. Does that mean go under contract on a property, or is that more so just like, hey, this is a property that I want to buy. I've identified it. Now I have 180 days to get it under contract and close on it.
So you just need to identify it. It'll be a part of a formal list of this property and the purchase price. Yes. And then you have 180 days to close on one of those properties.
Got it.
So you have to close on one of the properties that you identify.
Yes. Now, two questions I have. If I don't use a 1031 exchange, what's the capital gains tax today?
So it would generally be 20%. You also need to, hopefully you held it for at least a year.
Okay.
What if you didn't? Held it for a year? So then you would be, you could be subject to short-term capital gains rate.
Got it. Which I assume is higher.
Yep.
Got it. Okay. Yeah, that's crazy, man. Because I just think about, again, friends of mine that are flippers, full-time flippers, and they're not holding properties for a year. And my partner Steve and I, we just closed on a house yesterday, and this is going to be our first flip together. We'll see how it goes. We may end up just, burring out of it, but odds are we're going to try to flip it. And there's, we bought it yesterday, which was April 1st at the time of this recording, and we plan on selling it by July. So obviously, we're going to be talking to you about what to do with that money. But it's just crazy to think about people that do it at such volume. If they're not 1031ing it, they're getting slapped with these taxes. Is there any way for them to offset a capital gains, right? So if they get hit with that short-term capital gains, what is a flipper doing in regards to tax planning to make sure that they don't pay a hefty bill?
Yeah. So, it's really just making sure you have someone that can take a look at all of the activities you have going on, because maybe you have, some stocks that you've been holding on to and that you have an unrealized loss there that you can just trigger and kind of help offset. So that's really where a tax advisor comes into play.
Yep.
And, really understands your situation and understands all the tools that are available to you.
100%. And I know you've pointed out this to me as well before, like there's a significant difference between a tax advisor and a tax prepper. What does that mean to you, CJ?
Yeah. So a tax preparer is really someone that you're, the traditional accountant that you just drop your documents off in, March, April, and they're filing your return and you're kind of just hoping for the best result, right? Yeah. There's not a lot you can do at that time. The year is closed. For right now, it's 2025 and we're working on 2024 tax returns, right? So the year is over, very limited as to what we can do now to help you. That's a preparer. They're preparing and filing your return. That's the compliance component, that the IRS requires you to file a tax return. Yep. An advisor is more of a proactive approach to things where you're meeting with someone multiple times throughout the year, discussing your situation, what you have in the pipeline, and putting together a plan that will optimize your tax situation so that when we get to this time next year in April, there's no surprises. You already have an understanding of, what your tax bill will be, hopefully minimal. And, you have a plan in place and you took advantage of everything that you knew was available to you.
Yeah. I honestly think like what you just said is maybe one of the most important things that we're going to talk about on the podcast, is because a lot of people, I think, are going to listen to this. They're going to be like, oh, this is really good tax advice. But then they're going to fall back into the same recourse of you go through the year, you finish it, you go find somebody to file your taxes. And I say this from personal experience, right? And I think it's so important. Again, we brought it back to before, is having your team of advisors. Like, you are an advisor on the team. You are looking at strategies for how they can make money and save money and how they can continue to grow a portfolio or continue in their real estate investing strategies. So I think that's very, very important. I have a few other things that I want to touch on before we start kind of closing out. I want to be cognizant of your time as well. But let's look at it from the other perspective, right? You're not someone like myself who really flips houses. We're doing more of the burrs. Or, maybe you just have a few properties as an investor and you're like, I want to tap into the equity. Let's talk about cash out refinances. What does that look like from a tax perspective?
Yeah. So with the cash out refinance, also a great tax efficient way to access capital, because when you refinance and distribute out those loan proceeds, that doesn't trigger a taxable event. Mm-hmm. The only, the tax consideration you do have, when this is kind of getting technical in the weeds, is you do trace those loan proceeds to where you're spending those dollars after. Okay. So, you distribute out the loan proceeds and go buy a boat. The interest expense related to that would probably not be deductible. But as long as you're distributing those loan proceeds out and then buying another investment property, that would generally be deductible interest expense. So got it. Distribution of the loan proceeds is generally a non-taxable event, which is great. Yep. And then it's just consideration of the interest expense now for that loan, being able to deduct that interest expense going forward.
Got it. Now, if you are a single member LLC and you cash out a deal, and let's just say you pull $25,000 out of that cash out refinance and you distribute that, you just put it as an owner draw, right? And you put it in your pocket. How do they track what that gets spent on? Is there
That's
a way
really on the burden of that is really on you and your CPA to track it. There's no way for them to know, other than if you ever got audited and they wanted you to show the tracing, you would have to be able to substantiate it. So we always get back to the same thing of documentation is key. Yeah. But I do know from just working in this industry for a while that is something that gets missed a lot. Yep. But more of the technical real estate focused CPAs know that interest tracing rule. And, most of the time you are reinvesting those proceeds into another real estate project. So it's really a non-issue.
Yes. Yeah. And that was actually the first time I heard about that, the interest tracing, because I didn't realize that if I take tax out, or tax-free money in equity and I go buy a boat, I can't deduct that interest on the boat. If you are, again, I'll just use single member. It's easier to do that. If you're a single member, and I think I know the answer to this, you're getting cash out refinances, you're distributing that out. You're getting rental income, you're distributing out a percentage of the rental income. My question was going to be, how do you really show, like, what's my income that's taxable through the rental income side of things, but the equity isn't? I think the answer is going to be documentation. Correct me if I'm wrong there.
Documentation. So you're going to be taxed on the income that is generated, the net income, right? So rental income minus expenses, depreciation, things like that. That's what you're going to arrive at, a net income number that's going to factor into your tax situation among the other components and sources you have.
Yes.
And so that's how you're going to be taxed on the net income, right? But then you're going to take distributions, and that's just where you would just kind of want to understand what makes up that distribution component. And if it's a year of refinancing, just having some additional documentation there.
Makes a lot of sense. Yep. I want to talk about, one thing that we did together, you and I, is we extended, my filings. Why in today's economy and kind of climate should people maybe think about doing that?
So the big thing this year, right, is, it doesn't, it's pretty easy process to extend. You do want to keep in mind for your business returns that were due 3/15. It's a pretty easy process to extend. Yep. Those are passed through entities. Everything kind of flows to your personal return. Right. Now, personal tax returns are due April 15th. And that's where a little bit more analysis is needed to just understand if you're going to owe tax or not. Because while you can extend your tax return an additional 6 months till October 15th, you do need to make a tax payment by April 15th if you anticipate owing, to avoid any interest and penalties that could be assessed on the tax due. And so the big thing this year, and why we're having the discussion whether it makes sense, even for returns that we've kind of completed, does it make sense to extend and kind of sit on them, is for this year, it's bonus depreciation, right? The percentage, in the last several years has been 100 and declining, year over year, to where in 2025, it's at 40%, 2024, 60%. But now with the new administration in office, there's a lot of talks about 100% bonus coming back. There's no, at this point in April, there's no concrete evidence of that happening just yet, but there's a lot of chat about it. And so we're just wanting to see, hey, how does this play out? Is it a case where 100% bonus is going to come back and it will be retroactive to the beginning of the year? We want to see how that plays out. So we're having the discussion with our clients on a situation by situation basis.
Yeah. No, that's awesome. Again, things that I've never heard that are being talked about right now, which is really awesome. I want to kind of end on one topic before we kind of get into where people can find you and stuff like that. The audit. I think everybody hears the word audit and they cringe and, they get scared. Why do people mainly get audited? And what's the process like if you get audited?
Yeah. So, there's definitely things that can trigger, definitely give a red flag, right? So, if something stands out in the sense of like an aggressive or an expense for like your industry, right? So if you are, if you have like a meals and entertainment expense of, 6 figures and your business makes, 50K, that could be a little bit strange, So there's certain egregious kind of expenses that may trigger something like that. But it really is a little bit unknown as to like when they flag for an audit.
Right.
And really it's something that creates stress for everybody, right? The taxpayer that's getting audited, the CPA. But what makes that a lot less stressful is just like we always get back to the documentation and, having that advisor in your corner that, talk through, every step of the way to where you have everything squared away, right? And so then it just becomes a conversation of, here's my documentation, here's my support. I'm not stressed at all because I know I, had everything justified within the tax law.
Yeah.
So yeah.
And I think as you were describing that, I think there's probably a handful of listeners that were thinking about the Wolf of Wall Street scene where the dad comes in and he's like $36,000 on a dinner, like that. And I think about it all the times. Me and my associates went to Barclay Prime, and I'm like, yeah, that hopefully we don't come across anything. But I think one thing that I will just highlight on you, and I'm going to talk about where people can find you and stuff like that, but is you're in real estate, like this is your realm, right? And the services you provide, at least for the time, the short time that you and I have been working together, I very much think you're extremely communicative. I think you guys are very educated. I think you bring a lot to the table. Where could people find you? How could people get involved with your firm? Feel free to talk a little bit about that.
Yeah. So on social platforms, mainly Instagram right now, CJ the CPA. So we're posting content daily, helpful and practical tips from just things I'm working on with my clients, questions we get asked a lot, and just kind of putting that out there as value. So definitely follow us there. And then, we are accepting new clients at this time, and would love to work with anyone that may need some help. The way our process is we offer a free discovery call just to make sure it's a good fit, confirm we can help you. We don't take on anyone that we don't, we're not confident that we can add value to. Yeah. So definitely would love to have a conversation with anyone that needs some help.
Yeah, well, that's awesome. And CJ is very active on Instagram. He posts, like you just mentioned, you guys post him reels, and I find all of them very, very valuable. So at the very least, if you follow, get some good content from there. And like I said, he's in the space. And because of the way I post, CJ actually reached out to me, and it came at a perfect time because I was looking for a CPA. Exactly what he just said. We had a discovery call. First things first, he asked, what's my plan? Like, what do I really want to accomplish? And started tailoring strategies based off of that. So again, I can't speak highly enough about CJ and his firm. CJ, is there any last minute notes or comments that you want to leave with the listeners?
Yeah, I would just say, you definitely want to take your tax advisory seriously. Be proactive about it. You will find that the peace of mind and stress that's eliminated just being ahead of your tax situation and not just getting really stressed out in April, you will find that will be great value to your life and, just being able to focus on real estate and grow your portfolio.
100%. One last thing I will say is you are a dad, right? I know you got kids. You're in the busy season right now of filing and all of that stuff. How do you kind of juggle? I think this is a question that I get from a lot of people. It's just, how do you juggle being a full-time entrepreneur, business owner in the space with, kind of kids and family life?
Yeah. Good question. So actually I have 3 kids now. Youngest awesome. One is 4 months. So we're in the thick of it there.
Dude, we're in the boat, man. Mine just turned 1 month yesterday. We're in the boat together.
It's awesome though. Definitely a blessing. So what I have found most helpful is I get up really early, most days, 4:35, and I get out in front of it, whether that be a workout or just jumping right into work. Just to kind of get the day started right, because, once the kids wake up, that they're, you want to give them some attention throughout the day too. But, it's always the balance of life, right? How do I focus on all the things that are important to me, my clients, my business, my wife and my kids as well.
100%. No, dude, I think it's a great start. It's getting up before the sun does to get the work done for sure. Well, follow CJ at CJ the CPA on Instagram. Like I said, he's bringing out some great content, and visit his firm. I think they're going to be able to provide a lot of value to you guys. CJ, I really, really appreciate having you on. Everybody pray the rosary, buy real estate, and we'll catch you on the next one. Peace out.
Thanks, brother.
Absolutely.